Welcome back to the Lambar School of Minds. In this module, we're going to discuss what is a PIP. Now, a PIP is actually an abbreviation of the meaning point in percentage, which is the unit of measure to express the change in value between two currencies. Now, what that actually means is that when the currency exchange rate is actually going up, or when the exchange rate currency is coming down, there has to be a unit of measure that's going to measure it going up and to measure it going down. And every single time the market moves 1 pip or 1 point, this is how traders are able to make or lose money buying and selling inside of the foreign exchange market. Now, to better understand PIP, let's break down what the price actually looks like and how to read it. Now, anytime we get a price is going to be broken down into 3 parts. We have the base currency, which are the numbers before the decimal, and the 2 numbers after the decimal. This is the basic currency of exchange for the country that's getting traded. So, in this example, we're on the Great British Pound for the US dollar. And that means that the Great British Pound for the US dollar is at an exchange rate of $1.31 through the British pounds. Now, the 3rd and 4th decimal, these are the fractions of the currencies that are moving and calculating when the markets are going up and when the market is going down. Every single time this unit of measure changes by just 1 decimal, the pip count is either going up or the pip count is coming down. Now, in this example, we can see that the Great British Pound to the USD started at 1.29,900 and risen to 1.31,800. Now, before we get into that, let's take a look at the pip count that was happening in between. Now, as we see here, let's take a look at this current price of 1.3110. When the exchange rate changes from 1.3110 to 1.3111, this is an example of the pip count going up by 1. Every time the market moves a pip, we are making or losing money. Now, as we see here, as the value continues to rise, the pip count will continue to rise. So the pip count will then go from 1.3111 to 1.3112 to then 1.3113 to 1.3114 to then 1.3115. So as you see, it's continuing to rise. Now, there is a 5th decimal happening in the majority of the currencies, which is known as the pipette. Now, the pipette is the fraction of the pip. Now, since the pipette doesn't play such a significant role, many traders don't even acknowledge the pipette, and they simply look for price in terms of the base currency and the pip. Now, let's jump into an example. Let's say we were looking to buy the GDP US dollar right here at this wick of 1.29900. And then the GBP USD had risen and came right over here to 1.31800. What we can do to find out what the pip count is simply subtract the pips inside of the number. So by coming over here, you can see that I took 3180 and I subtracted it by 2190, which were the digits on the right side of the decimal. Now, by minusing these 2 numbers, I was left over with a remainder of 190. Now, that 190 represents the pip difference from the price rising of 129,900 to 1.31800. Now, this is very technical, but luckily, through technology and using our trading views and our MT4s, which is MetaTrader 4, we're able to simply measure the pips using a tool. So now as I come over here and I get a measuring tool, you'll see right from this point, as the box goes up, you can see the pip count actually rise. And you can see from line to line that the market perfectly went up 190 pips. Pips are a trader's best friend, and you'll hear a lot of traders using the phrase catching pips. You see, catching pips is a way a trader expresses the amount of pips that they were able to net or secure in a buying or selling position inside of the market. Now, coming up, you're going to learn what lot sizes are, and lot sizes are a way that you can use in combination with your pip count to see how much money you would make or lose on a trade. We hope you found this educational, and we'll see you in the next video.